if you do the Roth 401k, which I'd advocate anyone out there to do it because tax rates right now are the lowest they've been since 1982. You still get your profit sharing, you still get your match, whatever you want to call it. You're still getting your money, and that's so important.
And welcome into Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, your resource, ladies and gentlemen, to make that financial progress that we all need to in order to achieve lasting confidence in our comfort and lifestyle. That's not what ultimately it comes down to as far as money, but that's what the money supports, right? Money, not the most important element, but the money is the tool to support that comfort and confidence in our lifestyle. In other words, Tim, recent string of fumbles at the beginning of the program, trying to figure out how to talk here, but we are also trying to figure out, now that tax season is behind us, or for many of us at least, we're done filing those taxes. What's next? And perhaps we're not all done filing those taxes, but what do we need to be thinking about as we are nearing the end of tax filing season?
Well, to your point, I mean, some people are still on extension and that type of thing, but at the end of the day, you need to look ahead and try to learn from last year, what you did right and what you did wrong, and then get ahead of it. And so one of the things we're talking to our clients about is, for example, maxing out your 401k and making sure that you know what the contribution limits are. If you're over 50, what the catch-ups are, which is like $8,000 this year. Then you have the age 60 to 63, those special catch-ups, which is $11,250. I mean, those are times that you need to take advantage of it. Every penny counts when you're going into retirement. But those are, huge things that, you can do now that will come back in spades to you down the road.
And if you max out too early, Tim, you've got a warning here that sometimes that results in missing some of the matching contributions. So be cautious if you are maxing it out. Don't necessarily check with your plan on the specifics, but don't do it all in 1 or 2 months at the beginning of the year, because that match could be a per paycheck kind of match, and you don't want to miss any of the match, right, Tim?
In other words, understand your own 401k. Yeah, that makes sense to me. No, honestly, you have no idea how many. I think a lot of people are very educated that come to us, but they don't understand how their 401ks work and that type of thing. And that's scary. You want to make sure that you do. So, yes, ask the questions. That's what HR is there for.
Yeah. I feel like taxes, Tim, are like elections. As soon as one is over, here's the next one right in front of us, right? Here, the election just happened. Here comes the next cycle of election ads. Taxes are over. Here we are right back in having to plan for taxes. There was an episode of Seinfeld where Newman was addressing why postal workers, sometimes go crazy, and he said it just keeps coming, it doesn't stop. Like that's how I feel about taxes and political ads. But we do need to understand them. To your point, Tim, another very commonly misunderstood aspect of those 401ks, specifically making the most use, people think if they put their money in on the Roth side that they might miss the match, they might not get it.
No way. Yes, you're correct that they do misunderstand it. If you do the Roth 401k, which I'd advocate anyone out there to do it because tax rates right now are the lowest they've been since 1982. You still get your profit sharing, you still get your match, whatever you want to call it. You're still getting your money, and that's so important. But more importantly, you're paying the taxes today on the lowest income tax rates we've had in forever. So do that and get your match, and off you go. It's such a great opportunity. Do not miss out.
Now, your company, nice enough to offer this match, probably not nice enough to pay your taxes for you. In fact, they're getting a tax break from making those matching contributions. So Tim, you don't have to handle all of this accounting. They track that inside of the 401k, right?
Exactly. They're going to give it right. They're going to give the amount of money that they match you on the profit sharing side. So when you do pull that money out down the road, when you're over 59 and a half, it will be taxable to you. But your Roth is going to grow like the seed into the crop that we talk about that will be all tax free. And I love that.
Yep. And new rule this year, Tim, if we are higher income earners
Yep.
taking advantage of those catch-up contributions, those dollars have to go into the Roth side at a certain income level, right?
Right. If you make over $150,000, that's exactly right. Which is, you know what? They're forcing your hand and it's a good force.
Yeah. Okay. You not a government move that you don't disagree with.
Yeah, for once.
Although I'm sure somebody at the IRS, Tim, has done the math on this and says, well, this individual is in a higher income tax bracket now. Why
Right.
not force them? And they can save extra, right? So maybe they're living off of less than what their tax bracket is. Why not tax them at the higher rate rather than the lower rate later? To play
Right.
devil's advocate. But I do like the idea of the Roths and some freedom and flexibility, which the Roths are a powerful tool to provide.
Right. And as we both know, if you make over a certain amount, you're not allowed to just do a Roth, you or your spouse. So good opportunities to take advantage of.
And in fact, Tim, the backdoor Roth strategy is one that those higher income earners often seek out, trying to get money, some money, whatever money we can, in a place where it can grow tax free.
Right. And a lot of people don't understand that. All you're doing is contributing a non-deductible traditional IRA deposit and then converting those funds to a Roth almost instantaneously so that you can actually have a Roth going. It's a lot of work, and I appreciate it, but you only get to put so much in there. Think about how much you could put in a 401k Roth. That's the thing that gets my juices flowing.
Yeah, and the backdoor conversion does require some careful consideration
Oh yeah.
and coordination. Clean execution prevents some unfortunate missteps and surprises. So
Right.
work with a professional on that one, because Tim, it can go wrong, especially if you've got other IRA balances. The government sort of looks at the money as being commingled immediately.
Right. I mean, and it's a lot of work. Make sure that you're doing it with a CPA. Any of our clients that want to do it, we use our CPA. Most companies, other advisors, I'll say, would not even touch that with a 10-foot pole, but we would help people with that.
All right. Well, we are talking about strategizing for taxes, not preparing taxes, not looking back at last year. Maybe that season has wrapped up and you've got your returns done. Fantastic. But it doesn't mean you stop thinking about taxes. Now's the time to start thinking proactively about taxes. And one of the considerations, Tim, is that Roth IRA. A lot of people under the impression that for whatever reason they can't get money into a Roth. There's no age limit. There's no income that necessarily says it's impossible to get money into a Roth, right?
That's correct. If you're
Almost
working,
anyone can do it.
yeah, exactly. I mean, Bill Gates can do it, right? Michael Jordan, whoever it is, you just have to have some earned income out there. But the bottom line is that it's a great opportunity to pay the taxes when the income tax rate right now is low and let it grow. And then when you pull it out down the road, all that money is tax free.
All right. Well, everything has pros and cons, so there's not all good with no bad here. What are some of the things to be aware of with Roths, the gotchas that sometimes get people?
Well, if you put money in there, the first for 5 years, it's quote unquote tied up. You can take out what you put in, but not the earnings. There would be a 10% penalty on that. You know,
Now, Tim, the value of the Roth is in the growth that happens after the conversion. So that 5-year rule, I mean, theoretically, we would want the money to sit in there for a long time after a conversion anyway to get the full effectiveness of the conversion, right?
of course. And the effectiveness is, one other thing that we didn't talk about is you want to pay the taxes. You don't want to pay the taxes from the converted funds. That, reduces the compounding, and it may trigger penalties under the 59 and a half rule. Not to mention you have the IRMA look back. So Roth conversions increase income, which can raise Medicare premiums 2 years later. A lot of people forget that. And then lastly, you have that 5-year rule, which converted funds have their own 5-year holding period.
All
So
right.
those are the things that we will forewarn people. But to your point, you're putting the money away for retirement. I would hope you wouldn't need it within 5 years.
Yeah, yeah. And prepaying those taxes, it comes with a cost, but you've
Right.
got to weigh when that cost benefit turns into a benefit, right? How
course.
long do you keep it in there? Hopefully for as long as you can grow tax-free money, right?
Yep.
That's the goal. So Tim, we've talked a lot about Roths and strategies and opportunities there. What about outside of retirement investments? I know that this also presents us with opportunity when it comes to long-term tax planning.
Yeah, I mean, we want our clients to be tax diversified. You're going to have some money that's taxable, like a 401k. You're going to have some Roths, and you're going to have some, accounts, like a joint account with your spouse or whatever. And those will be taxed at long-term capital gains rates. That might give you some tax loss harvesting opportunities. You have the step-up basis at death, meaning if I own a stock that I bought for $1 and I pass away, my kids get it at whatever it is that day, which is excellent. There's no required minimum distributions, and of course, there's no age restrictions.
Yep.
So, you want to make sure that your portfolio is tax diversified. Not everything should be in Roth, and not everything should be in non-qualified, like what we just spoke of, and not everything should be in IRAs.
Well, Tim, as we are getting to the end or wrapping up this tax season, which again is historical, looking back at last year, what should be on our checklist to make sure that we are post-tax season planning appropriately?
Well, it's a good time to money morning quarterback. So are you maximizing your retirement contributions? Should you be adjusting traditional or Roth contributions? Does a Roth conversion make sense this year? Are you positioned efficiently across your tax buckets? Are you diversified tax-wise? Should I increase taxable investing? And lastly, are you coordinating the different Medicare thresholds? And make sure that you're understanding those, because they move every year. And if you need help with that, that's what we're here for. And then make sure you're reviewing, adjusting, and executing. The year is still young, so take advantage of it.
Well, I think too many of us think of tax filing as the finish line, when in reality it is just the marathon, if you will, or the handing of the baton one year to the next, right? Still a ways to go here, folks. So let's make sure that we are planning for the future of tax efficiency effectively. And to help with that, an experienced, qualified professional guide, a CFP certified financial planning professional like Tim Stearns, CFP, on your side, helping you map out the Protect and Grow written retirement blueprint will be beneficial to you in lasting efficiency with your financial, your tax situation. Give a call if you would like to take Tim up on the offer for a conversation, a complimentary review, a retirement planning strategy session, and to get your custom Protect and Grow written retirement blueprint. 800-640-2256. That is 800-640-2256. 800-640-2256. And Tim, in your book, Solving the Modern Retirement Riddle, you talked about the fact that right now we are in a low tax environment. That is not promised forever. Even though the headlines are permanent, those things can change.
Right.
And we want to take advantage of these great tax rates while we have them.
Right. Nothing is permanent in Washington, D.C., as we know. But right now, I think we have about 3 years of these low tax rates. Let's take advantage of them, and then we'll look at it in 3 years.
Well, again, ladies and gentlemen, if you'd like to get your Protect and Grow written retirement blueprint, give TJ Stearns Inc., Tim Stearns, CFP, a call. 800-640-2256, 800-640-2256. Tim, always appreciate you being here on Protect and Grow Chicagoland Retirement.
Peter, thanks for having me.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.